Good evening, ladies and gentlemen. This is a weekend strategy video. And before we get on with the video, let me again remind you of our webinar on September 19th, 2020, where we'll be discussing several strategies similar to the one that I'm going to talk about. So still a few more seats to go. So please WhatsApp on 9871066337. That is 9871066337. Email on ashwani_gujral@yahoo.com. Email at ashwani_gujral @yahoo.com. So with this out of the way, let's see what I want to talk about. What I want to talk about today is called spring action. And spring action is extremely useful in indices particularly, although it can also be used in stocks, but more so on indices. So let me first go and explain the principle of spring action. Now this is our whiteboard, and say you have an uptrend. Post that it hits resistance, it comes off, and then you make another high, and that high starts to fail and your stops get hit and the market comes off. Similarly, assuming you are in a downtrend, you make a low and there is profit booking, then you make a lower low and again there is no follow through and the market takes out your stops. This can be done if you have one down day and you are trading below that down day's low. Obviously, you have to be in some kind of an uptrend. So you are waiting for the low of the down day to get crossed on the downside, and then the follow through is missing and you are taking the upside. Similarly, it could be one up day and you are looking for the price to trade above the high of the up day and then fail. Obviously, in a day trading context, the moves will be smaller, but the same thing can be done on the weekly chart. One down week plus trading below the low of that week and not finding follow through and going on the upside, or one up week. It could be more than one. The more the number of up weeks or down weeks or up days or down days, the better your odds become. So again, above previous week high, the market fails. So this is the basic concept, because what often happens is that most people, they tend to buy new highs or sell new lows. And where do they keep their stop? They keep their stop, around the previous high, and once it gets taken out, you collapse. Or on the downside, they keep stops at a previous low, and again the stops get taken out. So let me show you examples of this, and then we take it from there. Now this is the Nifty chart. Okay. Now the previous week low on the Nifty was 11,300, and we traded, I think, about couple of days below this 11,300, and immediately came back, and you got a decent rally from these levels. Similarly, we traded below this day's low, and immediately you got the upside on 7th of September. Let's go and see what happened on 7th of September. So 7th of September, we traded below the low of previous day. We did not sustain it, and you got an intraday upside. Oito, sorry for my dogs who find it very convenient to bark just at the point where I'm trying to make a video, but this is, occupational hazard. So this was one example. Second example was this day on, I think 9th of September. So again, 8th of September, we closed lower. Okay. This was 8th of September. 9th of September, we traded below this low and went on trading, made a fresh low, but could not sustain it, and finally closed at the highs of the day. So this is called spring action, particularly conducive for indices, because most of the time the indices are range bound. But what is the caveat? That you have to wait for the price to fail. Now, something like this, where the price opens above previous day high, consolidates, and starts to move up. So how do you make out whether it is this kind of a day or it is a day which will reverse? So basically any day which opens above previous day's high, if it starts to go sideways, then that means the chances are that it will move up. Any day where you have the price moving above previous day's high, coming back, making lower high, and then going through the previous day high, chances are will run stops of these long positions. Basically, you have three levels: high, low, previous day high, previous day low, and previous day close. The best traps are set up below previous day low or previous day high, and it depends on what happened before this particular day. Were you in an extended uptrend or were you in an extended downtrend? The bigger the downtrend, the better the move will be. The bigger the uptrend, the better the move on the downside will be. But it works on all time frames: daily, weekly, monthly, anything. So basically, if you don't have news and the market is not showing follow through, this is the kind of strategy that you should be working on. On Bank Nifty, we've had 2 solid weeks of decline. Okay. Now, what you are looking for after so many down days is that one of these days you will have a trap below these lows and the stops will get taken out. So the more the number of down days, the higher the odds of a trap being set up. Okay, so what we are looking for is, because Bank Nifty has reached some kind of a strong support zone, I think we should see at some point a trap being laid out somewhere around this zone. Understand this: the high belongs to the seller, the low belongs to the buyer. Okay, 8 times out of 10, when you break the low, you will not go lower, you will get back into the range. This is called mean reversion. Similarly, 8 times out of 10, you will not see follow through above previous high on all time frames, and we will come back to the mean. Okay. So be careful that the price should reject these previous key levels. In case the market is trending and you are getting these higher closes, then it is possible that the close acts as a support and you go up. The close acts as a support and you go up, but this happens very rarely on indices. Most of the time, the indices are sideways. So the idea is that you have a previous day high, you open above it or close to it, and you start to fail on the downside. You can, do your back testing and check whether what I am saying is correct. But it is the property of the instrument also, which is as important as the strategy itself. If you do it on a very trending instrument, chances are it will not work as well. Okay, so this is, again, as you can see, this was 11th of September, big upside move. It almost hit previous session high. You went short here, and as you can see, look at the decline you got. So prima facie, you should be ready to get short on decline on previous day high and get long on previous day low. If you see here, this was the low for 10th of September. Again, we went down till, uh, you know, we went down till previous day low, and again we got a spring. And from that spring, look at the kind of move you got. This pattern happens all the time. I mean, at least once or twice a day, maybe 4 to 5 times a week. Look at the way the spring works. Previous day low, once it got rejected, look at the size of the move. You can do your weekly options in this, futures, whatever you like, but this is the sort of strategy which is best for Nifty as well as Bank Nifty, where you wait on these key levels from the previous session and act on them. The only exception is when something like this happens. You open above previous day high, start to come off and find support. See here, this level is not getting rejected. So what I prefer is that you go to a previous session low and you make a double bottom. Now this can be on the previous day, this can be on the current day, or a pattern like that. The spring, basically one peak is higher than the other, but in general the rejection can happen from the same level also. If it happens after this high is crossed, then the downside is larger. So since this video is about the spring action, let me show you one more spring. I've just seen it. Okay. Now here, previous day high is about here. We went above this previous day high and we made another high and then we failed. But if you are ready to go short below, above this high, then I think you can deal with this, because since it was a gap, and I always believe that in a gap situation, this bar actually starts from here. So it filled the gap, tested the high of this session, and then came off. But look at the psychology that it's getting everybody long. And once everybody is long, the market fails and comes down. So these are, this is the strategy and the related examples. I think with practice, you can make a fairly decent living from this spring move, because the indices are conducive, and what is happening is you know, that you are trying to catch traps. Okay, so again, we have one low, then we have another low, and the market makes a spring out of this. Each time, we get past a previous session high. Look at this one. Previous session high, opened above it and strongly came down. So this is the kind of spring action you want to see. Again, here, previous day low, and from this zone, you got a fairly strong upside. So always, above uh, previous day, previous session highs and below previous session lows, watch out and see if there is any sort of failure that is happening. That should be it for this strategy. Take care, trade well, and please consult your financial